Hello and welcome to The Upside. I'm Jordan Chevalier. With tax season now in full swing, Canadians may be wondering how best to approach the filing process. Joining me today to share her top tax tips and which common mistakes you can avoid is Fidelity Director of Tax and Retirement Research, Michelle Munro. Michelle, it's great to have you.
Great to be here, Jordan. Thanks for having me.
So let's start with the big burning question. When are personal taxes due this year?
Okay, quick hit. Thursday, April 30th.
Okay.
Taxes are due. So Thursday, so you're going to get it done before the weekend. Now, if you are self-employed or married to a self-employed individual, have a self-employed spouse, you have until June 15th to get those taxes done. But you still have to pay your taxes, if you have any owing, by April 30th.
Okay.
So all that is you really want to have it pretty much done by the end of April.
So end of day on April 30th. That's a good deadline.
Got to get them done.
To circle on the calendar.
Or sooner. You don't want to leave it to the last minute because it is stressful for some people.
Okay, that's a good note. I have a question here. People generally think of taxes and they say, I got a big tax return. Look at all this money I got. Why should people be reframing that? Or is there another way to think about that?
Yeah, you're thinking, yay, I got a tax refund.
That's right.
Yeah. But you actually, I don't want to damper anyone's excitement. You actually gave an interest-free loan to the government. So maybe you may not want to do that. On the flip side, if you owe taxes, well, you received an interest-free loan from the government. So there are different ways of looking at it.
Okay, now what usually causes a big refund? So if someone says, well, I get a big refund every year, and Michelle is telling me that big refund might not necessarily be the best, how do we get that refund down closer to zero?
Right. So most Canadians are employees. They have T4 income, withholdings at source, going to the government to cover off their estimated taxes. So how they would get their taxes below that, typically it's because they have some sort of deduction or tax credit.
Okay.
So some of the common deductions are registered retirement savings plan contribution, getting a deduction for that. Maybe a first home savings account, getting a deduction for that. Let's see, what else do we have? RSP, maybe we have over withholding by our employer. We might have childcare cost deductions for credits, maybe medical expense credit, student tuition credits. What else? Donation credits as well. So there's quite a long list.
So there are things that people can do to look at if they always get a big credit to kind of move through and get that.
I would actually suggest going through the tax return line by line and thinking, hey, does that apply to me?
Right.
And I think most software is pretty good now of asking these questions. Did you make any donations receipts or make any donation contributions?
So that covers if someone gets a very big refund. What if someone owes? The other side of the coin. If somebody owes to the government, maybe they don't have the cash right away. They weren't expecting to owe. What should they do? It can be a bit of a panic, but what should they do?
It is. Well, that's why I always want to encourage people to at least start their taxes sooner rather than later. So you have that peace of mind. While you're getting a refund, well, now you're going to speed it up and get your tax return in as quickly as possible. But if you owe money, well, file by the deadline because if you are late filing and owe money, there's interest and penalties for late filing. The second part of that is through our hypothetical scenario, well, we're filing and we owe money, but we don't have that cash. Well, should we turtle and go, no. File on time because then you're not late, and then call the CRA and say, well, this is how I plan to attack it. And they have collections agents who will help you come up with a plan.
Okay, so that's interesting because some people, maybe myself included, can think of the CRA as a little bit hard to reach and maybe there's no point in calling, but you're saying there are people there that can help you. There are sort of a payment plan process that you can go through over at the CRA.
And just explain the situation and how you want to rectify it.
Okay, that's very helpful. And how can people also reduce future taxes? So let's say that this tax year has come and gone. People are looking ahead to next year. What are some of the reduction, strategies people can employ?
Where we see this most common is that the employee situation, there's withholding. Meanwhile, I'm making an RRSP contribution. So it kind of feels good. At the end of the year, I file my tax return. I get a big tax refund because of that RSP contribution. but it might have been better if I could reduce the withholding from my employer. So then I would have more money in my pocket all year round. I could invest that, I could increase my lifestyle, what have you. But to get that reduced withholding at source, employer source, we need to file a form. It's called a T1213.
Okay.
I had to pee.
1213, that's okay.
T1213.
Okay. So that is one.
You complete that and you submit that to your employer, and that gives them the certification to reduce withholding.
Okay, that's very, very helpful. The three sort of major personal tax vehicles that people can put money into, you think of the FHSA, the TFSA, and the RRSP. So those are the three big ones that people can open. What are the differences there, and when might someone want to prioritize one over the other?
Right, and the reason I'm laughing is because we throw around all these acronyms in the industry.
That's right.
So let's just simplify it a little bit. So let's start with Registered Retirement Savings Plan, RRSP. Okay. Intended for retirement. It's also the one that's been around the longest. You make a contribution, you get a deduction for that contribution. So we say it's made with pre-tax dollars. Okay. And now inside our RRSP, we can invest inside RRSP, mutual funds, exchange traded funds, stocks, bonds, what have you. The earnings on those investments inside the RRSP are tax deferred. Typically, when you're making a withdrawal in retirement, we make that withdrawal, then it's taxable. Okay, so tax deduction, deferred earnings, taxable withdrawal, RRSP. Okay, so tax-free savings account, second most popular one, it came in about 2009. So quite a while ago, but still relatively new. So we make a contribution to our TFSA. We don't get a tax deduction for that. Okay. But then, and inside our TFSA, we can invest in all the same investments. Okay. All the earnings inside our TFSA are tax-free. We can make a withdrawal from our TFSA. It's tax-free as well. It's also more flexible. So let's say I needed to take $1,000 out of my TFSA in 2026. I could recontribute that in 2027 in a later year. Okay. So there's a lot more flexibility with that. You need to be 18 to be able to open an account, and there's limits. The last one is the First Home Savings Account, FHSA. So the FHSA is intended for first-time home buyers. Okay. You have to meet certain criteria, make a contribution to that, get a deduction for the contribution. Now, inside the account, same thing, mutual funds, ETFs, stocks, and bonds. They will grow on a tax-free basis. And then when it comes time to buy a home, that first home, again, we have to meet certain criteria. That withdrawal is tax-free. So the First Home Savings Account really combines the best of the RRSP, because we're getting a deduction for a contribution, and we get a tax-free withdrawal for a qualified withdrawal from our First Home Savings Account. The best of both. So that was a long explanation. To your real question is, well, which is best? Right. I'm here. I've got a couple. What do I do? I got a little coin. What do I do? Right. Well, it depends. Okay. If you already own a home, you're probably not going to qualify for that First Home Savings Account. So now you're down to a TFSA or an RRSP. Right. So then I'm going to want to know, like, well, are you saving for the future, for your retirement? Or is this something like, I'm saving for a rainy day, maybe vacation, 2 years down the road, something like that. So you want the TFSA, the flexibility that comes with that. I think most young investors who have not purchased a home yet, who are just getting started, would benefit from the First Home Savings Account. Okay. Because they're going to get that deduction, grow on a tax-deferred basis, make a withdrawal tax-free. I should also point out, talking about the deduction, sometimes for young investors, maybe they're in a lower tax bracket today. They can make the contribution, let's say in 2026, but they don't have to make that deduction in 2026. They could claim that deduction in a later year. And when we would do this is when we're in a higher tax bracket. So get a better tax benefit for that tax deduction.
Michelle, is there any advantage if someone is saying, listen, I'm not thinking about buying a home this year or maybe in the next year, but is there an advantage to opening up an FHSA or a TFSA and just letting it sit maybe with some maybe minor sort of investments here and there?
Great question.
Okay.
There's a nuance. Taxes are sometimes complicated, and ask questions. Listen to a podcast like a video cast like this. So that first, let's start with a tax-free savings account. As soon as you turn 18, say you turn to 18 in 2026, when we're $7,000 of contribution room. Okay. And if you don't open it, if you don't contribute to that, well, it will continue to grow. So let's say next year you can get caught up $7,000 for this year, plus whatever the new contribution is for 2027. Okay. So there's flexibility there. First home savings account, I'm sorry, don't shoot the messenger. It's a little bit more complicated. Here it is. Well, you have to actually open the account. And if you meet all the criteria, basically a first-time home buyer, Canadian resident, et cetera, over age 18, you can, as soon as you open the account, but you have to open it at the financial institution, then you have $8,000 contribution room. You don't have per year. So in 2026, you open it, you don't have the cash to make the contribution, but you do in 2027, you can get caught up in 2027. Okay, so but the FHSA, you have to open the account, even if you can't contribute to it.
Very helpful nuance, but so there's some flexibility in sort of both areas there between the two tax vehicles. And what if you are a student? Let's say you're a student, you're filing for the first time, and you look at your annual income, and it's only a couple thousand. Let's say you made maybe $7,000 or $8,000 on the year, and you think, well, that's not worth it to file taxes. What should you do?
So you're like below the basic personal credit. You're not going to owe taxes, plus you have tuition credits that you might be able to claim. Maybe there's student loan interest you can claim against that. The list goes on. But the question you're asking is that, well, I know I'm not going to owe any taxes. Should I file my tax return? The short answer is yes. Because our RSP contribution room is based on earned income. So in our example, when we had $7,000, $8,000 of employment income, well, even though may not be contributing to your RSP, you're going to be earning that contribution room, which later on, future you is going to thank you for. As well as there's credits that are available. The biggest one I'm thinking of is the GST credit, but there's other ones as well. And I know when you're a student especially, it's nice to be getting that that quarterly check.
That's right.
It makes going out to the pub a little bit more fun.
That's right. So it sounds like the sort of overarching theme here is to get what you can do and do it early and sort of do it often and just get these kind of mechanisms running. Even if you're not taking full advantage, it's still important to open them up and have them there for the future. Right.
So opening up our first home savings account, if you have some funds, thinking about first home savings account, TFSA, as well as we want to be organized, start those tax returns. We can get into the system, start accruing that RSP contribution room, as well as we might qualify for some credits as well.
That's amazing. So Michelle, before we wrap things up, let's go through one final checklist here of things that people can be looking at. They're getting ready to do their tax return. They've watched the webcast. They feel informed. What do you want to leave the audience with?
Okay, so first of all, let's accumulate all those tax slips.
Right.
Do you have a T4 slip? Do you have any investment slips, a T3, a T5 slip, investment income? So looking at all the income. Then we want to look for our deductions and credits. The common deductions are RRSP, first home savings account, maybe childcare deductions. Maybe we have credits, medical, donations, tuition credits for students. Accumulate it all and really go through the tax return sort of line by line. It will take 15 minutes maybe. And it's also you have a sense of, well, have I really captured everything? Compare it to last year's return as well. As well as most software asks lots of probing good questions to help you complete it. Now sort of March, April time frame, this isn't really the tax planning time. This is where we just want to complete our return, get it done, get it into the system, get our refunds, or make a payment where we're able if we have to. But tax planning, thinking about these things, and we've touched on a fair bit. This is really a year-round activity.
Okay.
So you have to have me back, Jordan.
That's right. We'll have you back. We can go into tax planning so that everyone is well prepared to go into filing season in the sort of the March and April period. Well, Michelle, it was very nice to hear from you, and thanks again for coming on the show.
Great to be here. Thanks for having me.
And just a reminder that the Upside webcasts do air daily, so keep an eye in your inbox so you don't miss your invitation to the next show. If you haven't done so already, sign up for the Upside newsletter, again, so you don't miss out. Video podcasts are released frequently, both the Upside and Fidelity Connects. Just search Fidelity Canada on YouTube, Spotify, and Apple Podcasts. Thanks again for watching. I hope you'll join us next time on The Upside. I'm Jordan Chevalier.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.